Hey option traders, for today's trade we are looking at a bearish option play in oil and gas ETF, the Van Eck Oil Services ETF. The oil and gas sector has pulled back after a long period of outperformance alongside oil prices. So this ETF typically performs poorly when oil stocks fall, and with this there's also meaningfully less earnings risk like you get with individual stocks. But the top two holdings in OIH are SLB at around 19% and HAL at around 13%, so those two stocks could have the biggest impact on this ETF. Taking a look on MarketSmith, OIH has been struggling since June of this year when it attempted to break out above a cup with handle buy point. But the breakout failed and shares sold off in heavy volume. They also then undercut the 50-day line and then the 200-day line. Now the stock is still finding resistance at both key moving averages. So today we are going to be looking at an option strategy that has a bearish assumption, and it's known as a bear call spread. So a bear call spread is an excellent strategy for beginners, and it's used when investors expect the underlying stock price to fall. So remember, with options there are both calls and there are puts. With both calls and puts, you can either be a buyer or a seller, just like you would with any stock. You can either buy it long or sell it short. A bear call spread is a credit spread, which means that you'll collect a premium upfront for initiating the trade. So for this trade, we are both buying a call with a given strike price and selling a call with a different strike price simultaneously. And together, these create a spread. So both calls are on the same stock and have the same expiration date, but the difference in strike prices creates a range. The investor can expect a profit or a loss based on where the stock finishes within that range upon the option's expiration date. For the bear call spread, we expect the stock to go down between now and the option's expiration. The investor will net a credit for putting on this trade, meaning that you are paid a premium up front. Since calls lose value as the underlying stock falls, both options would expire worthless if the underlying price finishes below the lower call's strike. So here, the maximum profit would be achieved, and that would be the total premium that you initially received. But on the downside, if the stock price moves above the higher strike call option, both call options would have lost money, and the maximum loss for the strategy is realized. It's important to know your potential gain, loss, and break-even points for the trade. This will depend on the width between the two strike prices of the calls in the spread. For example, buying a 70 call and selling a 65 call creates a spread that's $5 wide. If the bear call spread collects $1 of credit, then the maximum gain is the $1 times 100 shares of stock each option represents. So the maximum gain would be $100 if the stock price is below the short call at expiration. The maximum loss would be $400 if the stock price is above the long call at expiration. Take the spread width minus the premium received, and then you find your max loss. The break-even point would be the short call strike plus the premium received. So now let's talk about a couple rules for taking profits. First, if the trade has achieved a profit equal to 50% of the premium received, that can be a great time to take profits and move on to the next opportunity. This is particularly true if the profit comes in the first half of the trade. On the other hand, when a bear call spread moves against you, don't allow the loss to get bigger than 1.5 to 2 times the premium received. A second rule is to consider rolling out a losing trade in time to the next expiration. The next expiration could be a weekly or monthly option. The main thing to remember is that you only want to roll for a credit. Rolling out in time means tying up precious capital for another week or even another month. So it's essential that you receive a net credit for the extra risk being taken. Okay, now let's take a look at my trading platform and set up a real life trade using OIH. So looking at OIH ETF here, first thing you want to do, make sure that If you're on Thinkorswim, you select vertical as your spread type in this box. It'll make it easier to set up the trade. You can find your strike prices down here in the middle. We are looking at the 250, 255 strikes, and going to be on this side of the screen because this is where prices for call options are. And make sure that you are in the September expiration, September 16th. And down here, this is how the trade should look when you're about to send it out. You want to buy one 255 call and sell one 250 call, both expiring September 16th. We are looking at selling the September 250 call and buying the September 255 call to create the spread. Selling these two options generates roughly $120 in premium. The trade has a maximum risk of $380. The spread will achieve the maximum profit if the stock closes below 250 on September 16th, in which case the entire spread would expire worthless. And that would allow the trader to keep the $120 option premium. The maximum loss will occur if OIH closes above 255 on September 16th, which would see you, the premium seller, lose $380 on the trade. A stop loss could be set if the ETF trades above 240. As this is a bearish position, traders that think OIH could move higher from here should not enter this trade. As always, remember that if you're new to options, make sure that you practice with a virtual account before risking any real money. And please remember that options are complex and investors can lose 100% or more of their investment. So be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.